Power of L-Word, Liquidity in MENA, which is gathering experts and liquidity providers. Please help me welcome on stage our moderator, Hormoz Fayyar, Head of Institutional Sales at ADSS, who will now introduce his panel. Let's give him a warm welcome.
Thank you. Hi, everyone. So my name is Hormoz from ADSS in Abu Dhabi. And today we have an excellent group of panelists talking about FX liquidity, perhaps CFD liquidity as well. And I've prepared some questions for these guys. We might be able to take one question from the audience later on. I'm going to let you guys have a quick 30-second introduction of your companies, etc. And then I'll start with my questions.
Hi, I'm Lee. I'm part of EXPO Prime. Been there for about 8 months. We predominantly focus on liquidity with FX, CFDs, and a few other things. But keep it short for that. But.
Hello, everybody. My name is Omar Karyuti. I am the Managing Director of Commercial and Sales for Advanced Markets, emerging markets. And Advanced Markets has been a liquidity provider since 2006.
Hi, my name is Andreas Kapsos. I'm the CEO of Match Prime, regulated by SISEC liquidity provider.
Hi, my name is Arta Diligergis, really long surname, but I'm a quant trading manager, so I run systematic market making at CMC Markets.
And my name is Guy Hopkins. I'm CEO and founder of Fair Exchange. We specialize in liquidity management software and data analytics.
Great, Guy. I think you're the only one who's not sort of taking clients' money and trading, essentially. Okay, so I'll start with the first question. Volatility and liquidity events for the last year. What would you say is the big events that shaped the liquidity scene the last 12 months? If we start actually right here and then...
Yeah, I think the biggest one, which probably had a bigger kind of knockdown effect, was the war. As soon as anything happened there, obviously gold prices went, oil prices went. That had a knock-on effect to everything that moved in the market. I think oil tripled, gold is still rising. I think we had the effects on the cost of living in the UK, for example. I think from there we've just seen everything kind of spiral out of control. Then from a personal perspective, we had the UK government. I don't think I've ever had a time in my life where we've had 3 prime ministers within the space of 6 months, which is a good indication of how bad it was over there. And then obviously we saw parity with pound and dollar.
Yeah.
Those were the big ones, and obviously a personal one with the UK market. But everything kind of spiraled from the war, in my opinion.
It's been an interesting year, and that's saying a lot coming off of COVID. So obviously the Russian invasion of Ukraine was huge, sent European markets on a tailspin. Obviously there were serious concerns on the implications that would have on oil and other energies, especially after oil going negative in COVID. I would say also, the Japanese intervention, bank intervention. We saw some LPs even pull pricing during that time.
And it's ongoing, that Japanese story, right? It's happening
exactly.
now.
Talk about ongoing, the dollar. Everybody thought that 2022 was going to be so bad for the dollar, and here we are. It's like, multi-year highs. So that has been, causing some choppy markets throughout the year.
Yeah, I totally concur with both of my colleagues, especially Lee. Undoubtedly, I would say the war it was the highlight of 2022, and the rest were directly correlated. Everything that followed. I would also mention the FTX collapse as well, which affected the crypto, and it was a huge change and an event that influenced our business. Also, the Taiwan turbulence also affected a bit. So if I had to rank, I would say these 3 were the top ones.
I think certainly, obviously, geopolitical risk caused a lot of sort of uncertainty around liquidity, especially in commodities, energy markets. But you've got issues with raising inflation and uncertainty of inflation path and what's going to happen with interest rates. That would cause, obviously, volatility in FX markets. So luckily, FX has been interesting again because it's been fairly sort of uninteresting over the last couple of years. We've focused mainly on stocks and sort of indices, but now we're seeing shift into FX because of uncertainty around inflation. I think what that creates is a shift in paradigm in terms of where the liquidity is seen. So Bank of International Settlement publishes the tri-annual results on volatility, sort of liquidity in FX markets. Obviously, as expected, volatility has been at highest, so that resulted in an uplift in turnover. In fact, the March 22 was the highest turnover month, even above the pandemic periods.
So volatility, so that was one of the questions I have, is volatility in 2020 versus the COVID year versus last year. Do you guys know, anyone knows if generally the average volatility was higher last year than the COVID year? Or does anyone know that? I'm kind of wondering whether it was higher last year than the COVID. COVID had this 1 month of heavy volatility 2020.
Yeah, I think that's right. And I'd echo what Arthur was saying also about the return to interest rates environments. I mean, liquidity over the last 10 years has really been characterized by kind of pockets of geopolitical driven craziness interspersed with long periods of boredom and everyone moaning about how low volatility was. And largely that's a function of very zero interest rate environments. We had no interest rates for like 10 years. And that's one of the fundamental drivers for FX flows is movements in interest rates. And now that's starting to come back. So I think there is definitely a structural shift now back towards a more fundamental driven approach as opposed to just trading geopolitical risk.
And I think on the back of that, in terms of if we think where and how the liquidity is shaped in FX markets, what we're seeing is a shift from volumes going in sort of primary venues into dealer market into a more OTC world, so where people are trading more bilaterally, so directly with OTC providers. That could be explained probably by a number of factors, but one of them is probably whereby an OTC provider in bilateral fashion can price you more appropriately based on the risk profile you're giving them. So where in a low interest rate environment, the correlation or flows might have been very similar. Now we've got uncertainty, so we're seeing a diverse set of flows uncorrelated, which yields in a better market making opportunities. So as an LP, you've got more opportunities to price someone more uniquely.
Yeah. I think yesterday we heard on the economy panel that one of the interesting things I heard yesterday on that panel was that this swap-free thing that we've seen for the same thing with the last 10 years, low interest rates, swap-free, that's going to come to an end. And we're going to get the carry trade back where I think it was Drew Niff from FXCM Founders who was saying that back 20 years ago, they used to have these carry trades from yen market, Japanese market, etc. And that might come back, which is something a lot of people don't even know how that looks in the brokerage scene, where people are just sitting on these positions trying to make interest rate overnight, every night. And that might change the scene as well, and the liquidity.
It's tricky because, I mean, particularly in the Middle East, the concept of swap-free is very common, right? I mean, it's almost a given, let's say, amongst the retail. But you touched upon, like, it can't be like that forever, right? Usually some brokers tend to go more aggressive when rates are down, and the other way around. But when this cycle happens, I always worry about that end of the cycle, because that end of the cycle might lead to harm to brokers or clients, and that's kind of the reality of it.
Yeah. So speaking of that, if a small broker wants to do good sort of liquidity and CFD product management, what should they think about in this market, in this kind of maybe in the next phase of the market, or traditionally as well? Like, if you're a small CFD and FX broker, what's the tools, what's the things you need now to manage all this?
So I'm while I believe that there's a load of tech out there that will help you manage it and look for that, I do believe if you're a small to medium-sized broker, you're probably looking for a liquidity provider that answers the phone, that's there to, kind of get rid of any questions that you have, any issues that arise. Big moves in the market are there to kind of guide you through. They have these open lines of communication. You're doing the stuff that pretty much has been forgotten about. It's not like a ticketing system where, I have a big issue with a big move, my clients are asking all these questions, and then you have a support team or an automated robot that's sat there going, here, put it into our system, we'll come back to you. It's providing that support that, if I want to speak to my guy on the end of the line, I'm talking to my dealing desk within seconds. I'm talking to my customer support. I have open lines to my payment team, so I'm there covering margins. I'm looking after they're a small broker. We've all been a small broker, right? We know what it's like. It's being that guy that can help you grow to where some of these guys have already got to.
Yeah.
Definitely, I agree. Service is the big one, right? But your level of service is dictated by multiple factors, right? Ultimately, mainly, as a liquidity provider, is how much business you're getting, right? So if you get a lot of business, you're gonna make more effort into supporting. This is just the realities of any business, right? But here we have to also look at what would be the concerns of a small broker. Maybe they have some capital limitations, having to post margin at multiple places, reconciling.
Which is difficult in CFDs, for example.
Absolutely, yeah, absolutely. So my advice is do your homework, find one, maybe two, that give you access to a wide range of products and obviously good execution and spreads, and invest in that. And I think it'll show good returns.
Yeah, a lot of these guys won't have a PB or anything like that as well. So you've got to be able to kind of service that and give them the credit lines, for example, that's based on that trust.
Yeah.
Absolutely.
I agree. I would also add 2-3 other points because we do happen to onboard and service startups and small and medium companies at the moment, and obviously the cost factor. It's a big thing for small. They have to utilize their money the best way possible. So my first advice or consultation would be, first you get to know that the commercials you're getting are correct. So you need to do the proper research. Then the product, you need to be able to offer your clients what sets you apart, because pretty much the liquidity providers, they offer pretty much the same product. So you need to be able to offer that and also something to set you apart. The third, I would agree again with Lee, it's the support. The support is also very important. This is something that we are trying to do, especially with the new guys. And very correctly said, you need to diversify. Although my advice would be have definitely more than 2 liquidity providers. This is the right advice to give to someone who starts. You never know how things will escalate. So if I have to sum it up, these 3 will be important.
Okay.
If you fine gentlemen want to add something to this as well.
I agree with what Omali and Andres said so far in terms of service, and obviously being able to talk to a client directly, or client being able to reach out to you. Very important in terms of maintaining the relationship or long-standing relationship. In fact, majority of the time where we have successful relationships on both making side, so i.e. CMC Markets making into a taker effectively, let's say one of our institutional clients, or myself where I'm consuming liquidity from a market, successful relationships were always based on when we have conversation with someone.
And be available.
Exactly, be available all the time. But other few things I would mention, which are very important, is from servicing the customer's perspective is depth of products, so asset class coverage, so FX, basically truly multi-asset class, where execution quality and consistency. So now we're talking about like sort of investment bank grade execution levels, and the technology which powers that execution stack. So if you don't own your own technology, it becomes difficult because you've got third party involved. And this is where the guy is going to add a lot more than I can, but TCA and analytics. So like it's absolute for us, everything we do is data-driven. So analytics is core of everything we do. That's how I price the risk. That's how I manage the risk.
Yeah. Guy, I don't think you agree with any of that, right?
Hopefully.
No, I absolutely agree with what Arch just said. I think one of the fundamental changes we've seen in the last few years is move to more a data-driven approach to managing a business. And that's percolated right across the market now. And these days, everybody needs to engage with data specifically to understand what's working, what's not working. In bilateral relationships in particular, that's very, very important because you need this kind of balance between the commercial interests of maker and taker. If that starts to go awry, that's when bad things start to happen. So and that's I think quite a common theme now that we're seeing right across the market, a general adoption of a more data-driven approach for sure.
Yeah, so from a service-driven more to the data-driven, from support-driven, I mean, support's super important, but it looks like data component is now also a huge,
I think
to be able to support.
I think there are certain things that are just expected. So after we talk about asset class coverage, good service, all these things, of course, you just have to have those in a modern business, and they're expected by customers. It comes down to more about how do you start to differentiate yourself in new client pitches and winning new mandates, and what sets you apart aside from leverage ratios, whatever it might be, and a systematic approach to data is now something that we're seeing in the market, is something people are using as part of their sales pitch. Not just, oh yeah, we got some guys in the background do some data analysis. It's part of their actual initial pitch to clients.
Yeah.
Like on our side, as I said earlier, it's all data-driven, all systematic approach to everything. Even from support perspective, systematic approach to certain things helps you to solve support issues quicker. One of the things is, for example, you can set up a fantastic brokerage or market maker. You can have an alpha models, you can have a fantastic infrastructure in-house, but if you fail on the distribution layer, then you're not going to be successful. So it's a success and a data-driven approach throughout, from a perspective of inheriting the risk, managing risk, and then sort of outsourcing the price distribution to the clients. So if your connectivity to the client is lacking sophistication or data-driven approach, then you may actually not achieve the good results.
So as a side question, if on the CFD side again, so a lot of well, not everyone, but a lot of people are trading single stock CFDs and stuff. Is that in your opinion the way forward to this industry of single stocks inside CFD, or do you think that whole the big wave that was coming a few years ago where people wanted to trade stocks, the actual stock? What's the name for that? The stock trading versus the CFD stocks. Yeah. Is that trend anyone, I guess the brokers.
Actually, I think you referred to like the COVID years, right? Like obviously because that was a big boom. I keep saying COVID.
Everyone wanted to trade the stock.
Look,
Robinhood or whatever.
That created big interest from a new segment of the market, right? Young people started trading stocks. That wasn't very popular before. And I think the days of just, just offering FX, those are not sustainable anymore. You need to provide wide range of instruments, different solutions, even when it comes to stocks. You might offer stock CFDs, like leverage stocks, non-leverage stocks.
So the cash from exchange.
Yeah, or fractional stock. Yeah. I mean, you have to be innovating and adding new products, or else you'll fall behind. The most successful companies now are the ones that are kind of doing that, covering that 360 for retail investors, at least.
I was just going to say that I would look at it a bit more from the regulatory perspective about this, because if the CFDs are imposed to more regulation, perhaps the stock trading will even come back to being more popular. And as we have seen so far with the directives, it seems like CFDs are getting more challenges along the way.
Totally. Regulatory environment for CFDs obviously has changed, but you also got to remember that market conditions has changed. So interest rates again, stocks, CFDs are more expensive from financing perspective. So you're now paying back in the days you would pay a haircut, now you're paying 5-7% depending on markets you're trading in. So how sustainable is that in terms of versus the yield you get in a stocks market? We're seeing a huge demand from specifically MENA region for the cash equities. So we are, as going back to diversity of products, we are diversifying our company and moving into more traditional asset classes. I think over the next couple of years we'll see more demand for a traditional asset classes, cash equities, fixed income, options, that kind of stuff.
I was going to say, you keep hearing, every day we're getting requests for futures, options. So I'd imagine with the data that it all kind of marries up. If you're using that data in the right way, you're going to be able to manage all that expectation that the clients are going to give it, or they're giving to you. But yeah, I keep seeing it happen every day. So going back to your point, no, I think if you don't listen to your clients and don't listen to what's happening in the market, you are going to fall behind.
You'll fall behind. Yeah.
I wanted to move on to a platform question quickly. So it's a bit of a difficult question. I wanted to ask about how, if there's room for another platform, trading platform. I know all of you guys, well, none of you sell platform. Actually, Andreas, you guys have a platform that you sell, but to others, right? Only you guys don't sell a platform technology itself, right? So is there room for another new platform? Everyone's using these old platforms, MT4, MT5, all the usual. Is there room for another new platform from a liquidity management perspective, coming in with a fresh new technology, maybe with all this new stuff that's coming in mind? Or are we going to just stay with the latest version of MT4.5, whatever, all this stuff?
You want to?
Well, you have a view.
I was going to say, it will be good because I can give you the insight of what we're doing. I mean, when we launched Match Prime, we joined forces with Match Trade, and we use Match Trader platform, which at the beginning, if you would ask me this question 10 years ago, I think the answer would be completely different. But having onboarded all these brokers right now, using this platform, we never got back any negative feedback. So I believe, without a doubt, if the time for new entries in the market, now is the time. The challenge is which ones were ready for, because the demand is here now, who can be able to facilitate. And something that Arthur said was regarding having third-party technology. That's also very important. If you have something in-house, then you can facilitate the broker way much faster, and you keep him happy, and it's spot on. And fortunately, we have that, because when the client requests something from us from technology perspective, it doesn't take time to ask from the third party to develop it or do it for us. It's in-house, so it's easy to be accommodated to him.
Yeah, I mean, Guy, I think you guys connect to all the platforms out there, almost all of them, to analyze client flow and help see execution performance, toxicity, all that stuff. So you must have a little bit of a view of whether there's too many platforms out there, or you think there's room for a couple of good ones showing up now.
Yeah, I mean, the kind of platforms we integrate with and speak to are more kind of, in the kind of the middle of the value chain, if you will. So it's aggregation software and, liquidity fees and so on, as opposed to kind of the downstream MetaTrader, MT4, MT5, which I've never understood the dominance of MT4 and MT5, by the way. I think it's, why is there only one company that everyone trades on? But with regard to those kind of ones further upstream, there is always innovation. There always will be innovation, and there'll be smart new people who find there's a clever way to do new things. We're already just recently hearing a lot more people start to focus much more carefully on latency and throughput through their systems. You've got clients missing trades, or trading on old quotes, and that's something that people have always been kind of aware of, but they haven't really started to kind of dig into it. So now everyone's asking the questions: oh, how slow is that system? How slow is that system? And there's smart people who develop new smart stuff that does the job better, and I think there's always going to be space for that sort of innovation. Other firms will just fall by the wayside.
I'm no expert on platforms, but just to add to what has been said, MT4, think of cash equities, and if you were to list 5,000 stocks, for example, or for full US, UK offering, I don't think so you can do that through MT4 at the moment.
MT5 can.
MT5, yes, but there's a reluctance to move over to MT5.
Look, I mean, the success of the MT4 and mainly MT4 now MT5 platforms is well documented. I agree there's always room and time for innovation. Smart people come up with something new, particularly now with the changes in, for example, we're talking about MetaTrader. MetaCode's not offering white labels anymore. That's obviously generated a lot of interest in other platforms, exactly. I think it's we're going to find a lot of companies are going to come up with their own platforms, be it whether they're doing it in-house or through a third party that they're contracted with, but getting their own, so it's not just a color difference.
In-house developed platform for themselves or sell it?
No, whether, you mean for them to use or whether they made it, whether they developed it?
Yeah, I just feel like, if everyone's developing these platforms.
If you have the means, obviously, but it's a big undertaking, right?
Resources.
Yeah, resources, right? Worst case, you contract with a technology provider for them to build something for you, not just a white label of another a version of the platform. One other thing to also touch upon the equities and MT4, I think a lot of developments have happened and will continue to happen on the back end in terms of being able to manage all these products in the back, the financing, the funding fees, all that kind of stuff. So I think in this case, maybe it would be the bridge providers or the technology providers that are and should be upping their game.
But having said that, MetaCode's being the dominated platform, it's no secret. What we've seen is the tendency of the brokers to parallel launch another platform. So the change will not happen if there is going to be a change and more players will come, and they do. It will take some time. So it will be a parallel launch of another platform. And that's where the brokers will test, and without a doubt, now is the time for other players to enter the market.
Okay, makes sense.
Yeah, I think with MetaQuotes obviously taking the approach they have, I think it's opened up the space for guys that already have their own platform. So if you have the means and the capability to run your own platform, I think absolutely I'd love to see an all-in platform. I think one thing I've seen over the years is that no one actually runs a true kind of all-in-one platform. I think there's obviously issues with cross-collateralization, all these things, but if you can offer the all-in-one solution and eliminate that, like your broker-in-the-box solution, your true broker-in-the-box solution, I think you're onto a winner. But again, you have to have the means.
Yeah, I think the platform scene is so complicated. We've done it all. At ADSS, we've done the building our own, using others, used all the different kinds of platforms. We were always building our own as well. So just find it very complicated, more complicated than people think. It's just
you feel free to tell us your feedback about the platform. I mean, they're a bit at the beginning, everyone's hesitant to try something else, right? But as soon as they do, it's not that.
Yeah, there is no perfect platform.
Now their hands are forced. I mean, and in some instances, they have to. You don't have an option anymore. They have to. I'm curious to hear. So one of the things that you sell platforms as well, right? Because MatchTrade provides a platform and Liquidity.
Group-wise, yes, we do have. So MatchTrader Pro.
Yeah. So touching upon this point of the broker in a box, have you? I think you offer that, right?
Correct.
Have you seen like a big uptick in that demand?
Okay. First of all, the client can take an all-in-one, or they can take standalone products, but there was a huge wave of interest at the beginning, the first weeks of the update, but then later on, clients, they were more skeptical and more slow in the decision. Although it was a panic period at the beginning, which is expected, the good from our side, it was the platform hasn't built in one day. We've been building the platform for more than 9-10 years now, so it was ready to accommodate the demand that came in. And this doesn't happen to a lot of technology providers because we all thought that there was a so-called monopoly in the business. But yes, we have, yes. And I wanted to mention this before, but from a liquidity perspective, when clients are using the MatchTrader for us, they asked us to use the platform for themselves now. Launch it on the side with MetaQuotes, because most of our clients had a MetaQuotes offering to their retail clients. Now they want to explore. They want to try something else. They don't want to shift and migrate their business immediately, but they want to try. And this is something which is good because it gives us the opportunity to pitch and to offer something new.
Yeah. Although I always find it a conflict when a broker also owns and operates a platform. I always find that difficult to manage, but some people have done it in the industry. I just want to move on to another thing before we have another 10, 11 minutes. I wanted to do a definition thing where perhaps some of you guys can explain the definition of recycled liquidity. We hear that a lot. People say, oh, this is recycled liquidity. And also fair execution in the world of last look. Perhaps, Guy, we can start with you. How do you define recycled liquidity? The whole network is recycling FX liquidity in a sense, or are there? What's the definition there?
Well, I mean, simply put, recycled liquidity is, you're passing liquidity on to somebody else that didn't come from you in the first place. So you didn't generate your own price. So there are plenty of firms out there that do generate their own price, and they have an idea about where the market is, and they'll wrap a bid offer spread around that and skew and all that sort of stuff. And there are other firms that will take feeds in from liquidity providers, and they'll just pass them straight on to their clients. The reason that's a problem is that these big liquidity providers, banks, non-banks, whatever, they use their client franchises to take them out of risk positions. So they'll show skews and show, I'm a better bid and better offered. The problem of passing this data through to your client base is that stuff can end up back in the lit market venues, whether it be EBS or Refinitiv or any of these other platforms that the banks use for their own price discovery. So they find their skews being leaked back out into the market, which moves the market against them. So there's this kind of there's a very slippery nature of liquidity. People aren't genuine, they're just passing on liquidity from others. That can cause problems. And it's one of the biggest things when I speak to the big banks and the big non-bank liquidity providers, the biggest thing they care about is the leakage of their skews. People are taking their prices and they're sending those prices elsewhere, and those are ending back up on the venues where they started up. And that's a big problem in the industry. I know Arthur and his colleagues talk to the same people I do, and everyone's very, very focused on it. And it's something that everyone's kind of scratching their heads to try and figure out. So I think it's important to be understanding kind of where the liquidity comes from and where it's going. And that's a real challenge. And I think one of the really important points to think about here is what firms I speak to, if they're 100% B book, whatever, they're just going to be taking risk from their clients, and that's it. They're just going to be internalizing it all. They need liquidity sources from somewhere. Are those price discovery sources, or are they actually genuine trading sources? And the differentiation between the two is very, very important, because if your liquidity provider is giving you that price feed as a way for them to exit risk, then they're going to be showing you favorable pricing, which they're expecting you to trade upon. If you don't trade on it, then that's going to cause some problems.
Yeah, we've seen that become a problem for us as we're sort of expanding our client franchise on the institutional side as well, where the skew leakage becoming a problem. Completely echoing everything Guy said, my definition of non-recycled liquidity would be if it's coming from a principal risk taker. So if the liquidity
comes from
principal risk taker, so if a company is not taking any risk, or a provider, clearly that's just liquidity from someone else. So you go to the source. Who is the source of that price, as Guy was alluding to, and on the back of what that price has been created. So for example, in our space, we create our own pricing on the back of referencing the underlying market, but plus our inventory. So we're sharing this skew to other providers based on our inventory. So depending if we're long or short, we might be skewing the price, which is basically making it cheaper to trade with us in a certain asset or certain instrument at any given point in time. So that's I would define as a true market making and liquidity provision, because we're adding value to the market. But if I'm taking the prices from some other provider A, and I'm just marking it up, then I'm recycling them. I'm not adding any value to the market.
Well, I think there is a point though that you would have to reach the end client. So it's not necessarily that the market maker can reach the end client. He can't. So it's almost impossible for market makers to reach their end clients without a recycler or an aggregator in the middle, where you might have a client in Saudi Arabia that you might have to get, and then you have to pass on. Of course, you have to mark up or make some kind of money on it. So it's almost the cost of reaching the end client. But of course, that scene's going to change if everyone has access to everything.
Well, the big market makers, they all understand that they need distribution channels.
Yeah.
They need firms who are going to help them get their liquidity out to the kind of the end consumers of the liquidity, and that's obviously inarguable. But is that someone who's sat in front of Arta's platform on his phone, or is it someone who's then using that feed to make markets into EBS? Those are two very, very different use cases. And that's one of the things that the liquidity providers are most focused on. Like, is the time I'm sending out going to get recycled back out into the market? The flip side, of course, is also what Arta said about if I'm a principal market maker, the risk should stop with me. And I'm going to try and internalize that the rest of my franchise. If I just, every time I get a trade, I dump it into the lit market and take all the available liquidity out there, am I adding much value? But from a credit perspective, perhaps. But in terms of actual genuine liquidity provision, probably not.
Just to add something, correct myself potentially. So there's obviously a space for platforms and providers who are not really providing a true liquidity, because they're providing some additional services in terms of aggregation technology. So let's take Prime of Prime, for example. They fulfill a very important niche where a consumer of that liquidity provided by Prime of Prime. Yes, Prime of Prime might not be providing their own liquidity, they're just aggregating the liquidity from non-bank market makers. But they're adding value, they're providing an aggregation service where the client might choose to outsource. To be able to aggregate, you have to have a pretty significant technology stack and pretty sophisticated technology stack. And then you have to police your aggregation stack through likes of TCA to ensure that you're actually getting a best of what you could be achieving in the aggregated environment.
Yeah, from a definition perspective, I can't really argue with anything you guys have said, but from the usage of Prime of Prime, I mean, there are a lot of brokers out there that are small, medium size, that don't necessarily have the bank account to go and get a Prime broker to start doing it legitimately. So Prime of Prime becomes important for these guys to kind of just enter the market. So I mean, we can argue about abuse and various other things and how they're distributing it, marks up, etc. But for some brokers out there, it's the only option they have. I've done a couple of startups, and you know, we had no option. We can talk to these guys, but when you're at the start of your journey, you're not even doing a yard of flow a month. So you need a Prime of Prime that can come in, look after you, hold your hand in a sort of way, but you know, are there and can help you into the market.
Yeah, and the issue that the Prime of Primes often face is that if you've got, say, 5 liquidity providers and one of those gets rid of their risk very, very quickly, then the other 4 start to complain. They say, well, hang on, every time you trade with us, you're trading with somebody else who's dumping their risk into the market. We're losing money now, and it can cause you quite difficult problems managing those conversations, because 4 of the guys are holding on to risk, one guy isn't. Then there's a rush for the exits, and that's when it can get there's quite sticky conversations. So, that's why most big liquidity providers will want to know that the other guys they're competing with are genuine providers of liquidity, i.e., the risk will stop with them.
And your tech can easily detect and help.
Yeah, I mean, you look at post-trade market impacts. I mean, I know Arta looks at this all day, right? This is what the kind of thing. When we trade with certain firms, what happens? Does the market stay flat, or does it move away, or whatever? And that's. People have been doing that for quite a long time to understand where those kind of liquidity signatures are. And that's very important to understand, and an absolutely integral part of the liquidity management process.
Okay.
Just to add one thing, I do see a trend in brokers either looking into or actually are deploying resources into generating their own price. That's definitely...
That brings me to the question of the non-LP, non-bank liquidity providers, like the famous XTXs and stuff. A lot of you want to be in that space, I guess, and become a non-bank liquidity provider. You want to be there, right, Omar?
Yeah. I don't know if I'd go that far, but I think there's value to be added from everybody.
To use tech to provide your own prices to...
I mean, it's even a way of accommodating flow. As well, and decreasing, the impact that these orders have on the market as well.
Yeah, market impact. Wonder if there's any questions from the audience. Otherwise, we'll continue and see any other thoughts on the XTXs and the non-banks. They have a space. I know you see a lot of that, huh?
I think they've done an absolutely unbelievable job, XTX. They're real visionaries, and they are really pushing the boundaries of the market, and they're real thought leaders. And I think one of the non-bank community has really moved from being high frequency predatory, kind of this reputation they had some time ago, to being we are actually genuine liquidity providers without the kind of the baggage of having a bank attached, which is basically what happens more broadly across the market. So they are purely driven by P&L. And they have, in big banks, okay, we might be losing money on spot, we're making it in options, or we're making it in rates, or we'll keep the relationship going. XTX are driven by pure P&L, and that's a very pure conversation to be having. They're genuinely focused on performance, which I think is very constructive for the market more broadly.
Just to answer your question in terms of non-banks market making still going strong, absolutely, and I think you see new providers emerge, likes of XTX, obviously focused on alpha research, and that's what drives their market making activities, price prediction and that kind of stuff. But you also have other non-bank market makers emerging with market making based on their inventory. So, for example, we've done a massive tech revamp over the last 2 years on our side, where we've moved into LG4, completely new cage, low latency, everything super optimized, because we've been setting up for. We realized effectively back in the days that we've been giving too much, have been leaving too much meat on a bone when we were hedging with our liquidity providers. Everyone was going after the retail providers. You can kind of see that still happening with likes of Citadel's jumps targeting the retail market, because they know there's a lot of revenue potential. We realized rather than buying to reduce our risk, we could be market making to reduce our risk, and that's our move effectively.
Yeah, excellent. I think any questions? Otherwise, we have to finish this panel. Don't think we have any questions. Yeah, there's one there, I think. Who's going to get this one?
Thank you. This is to anyone on the panel. So I'm Sean from BidX Markets and Trading Research. So you talked a lot about, in the last piece, about liquidity challenges. So in the MENA region, what would be your biggest challenge specifically? For example, gold carry, crypto liquidity. What would be like the most burning challenge you're facing at the moment?
MENA region specific challenges. Omar, perhaps, what would be specific here?
You kind of named them in your question. I think as we touched upon the swap-free indicator trading, I think that's the biggest one.
The swap-free,
yeah,
coming to an end.
Yeah, especially now, it's I would say it's the biggest problem.
Okay, great. Thank you. Thanks, everyone.
Thank you.
Thank you very much.
Thank you guys.